Let me begin by saying that I'm optimistic about the economy's prospects. Let me give you a few numbers just to make that concrete, and then I'll try to defend it. GDP has been growing about 2%-ish since the recovery began. The recovery is almost 4 years old. Hard to believe, but it's been 4 years of recovery. Q1 is actually going to be close to 4. It was a pretty strong quarter, but that comes after no growth in the fourth quarter of last year, so you average it, it's still about 2% growth. I don't think things change a whole lot over the next couple, 3 quarters. It's going to be a 2% year. Calendar year 2013 is going to be a couple percentage points. But I do expect much better growth in 14, closer to 3.5%, and even better than that in 15, growth of over 4%. So that means more jobs. The economy's been creating a couple million per annum. That's what we've been doing for the last 2 years. That's roughly what we're going to create this year, a couple million jobs. But next year I expect 3 million, about the same in 2015. And that means unemployment will eventually come down. We're at 7.6. I don't know we make a whole lot of progress this year. If we do, it's only because the labor force will continue to decline. But I do expect a lot of progress in 14 and 15, and I expect to be back to full employment, which is an unemployment rate of 5.5–6% by mid-2016. So June 2nd, 2 p.m. Eastern, something like that, we'll be back to full employment. Let me say 2 things about the outlook before I move on. First is I am more optimistic than the consensus. If you take a look at the Federal Reserve's forecast, very similar for 2013, Q4 over Q4, my forecast is 2.6. That's right at the midpoint of the Fed forecast. But I am stronger for 2014 and 2015. I'm more optimistic. The second thing I'll say about the forecast is, and you should know this, I've been wrong. I've been overly optimistic for the last couple of years. I've expected more from our economy. It has been disappointing, particularly in terms of GDP growth. Not every measure, but in terms of GDP growth in particular. And I've done a lot of soul searching and trying to ask why. I think one of the key reasons is the long shadow of the recession itself. I underestimated the damage the recession did to the collective psyche. I'm a numbers guy, and I have models, and I didn't pay enough attention to sentiment. It's very important. Confidence is key, particularly when you go through such a wrenching period. And I underestimated the gravitational force from what we went through. So I think that's been a significant drag. I think also the nature of the shocks we've been grappling with have been conflating with the lack of confidence. So, the European debt crisis, it's pretty hard to handicap the risk that poses. If you're a business person, you have a pretty good grip on what's going on in your industry, certainly what's going on in your company. You can attach a probability to the risks that you face. But to attach a probability to a crack up of the Eurozone, that's pretty difficult to do. You can listen to economists like me say it's 1/3 probability, but appropriately so, you don't believe it. And if you can't attach a probability to something, you can't plug it into a spreadsheet, then that means, it doesn't mean you're going to cut employment, doesn't mean you're going to pull back on investment to a significant degree. That would be recession, but it doesn't mean you'll freeze. You won't engage, you won't take the risks that you normally take. And the fiscal issue is also very similar kind of existential threat that's very difficult to attach a probability to. You go back to the summer of 2011 when it felt like we were going to breach the debt ceiling. We felt like we were going to shut the government down a couple of times. That really makes people nervous, and I think particularly in the context of the lack of confidence. I also think, regardless of how you feel about Dodd-Frank and healthcare reform, I'm not commenting on the merits of those particular reforms. There's good and bad in both of them. But I think it's pretty straightforward to say these are pretty wrenching changes for the financial system and for businesses in general to grapple with. A lot of moving parts. The moving parts are still moving in many regards. And until we get full clarity, it's hard for businesses to really engage. So these are the kinds of things I think conspired to cause the recovery to fall short of my expectations. Now, you may be asking, well, why do you think any different now? I'll have to say, it feels like to me, and this, I know that's squishy, but it feels like to me confidence is in a much better place today than a year or two ago. You know, I talked to lots of different business people and lots of parts of our economy all across the country, and there is a palpable change in sentiment. Actually, here in San Francisco, it's unbelievable. You know, take a look at the city. It's just incredible what you see. I come from Philadelphia. That's not quite San Francisco. But even there, confidence has improved. Those existential threats, they feel a lot less threatening. You know, given what the European Central Bank has done, the commitment that they've made, you know, it seems very, or I should say, much less likely that the Eurozone will crack up. It's going to be a slog for Europe under any kind of scenario, but they'll keep it together, and so that threat is just feels less threatening. And even the fiscal issues. I mean, we've got the debt ceiling we got to get around. That's coming up. But that's the last big hurdle. And you know, the odds are now much lower that these folks are going to, in Washington, are going to take it right to the brink. And you know, there'll be some brinkmanship and some vitriol, but I don't think it'll be on par with what we've experienced. So, and Dodd-Frank, healthcare reform. We're well on our way to nailing those things down. We're not quite there yet, but a year from now, I think those issues will be resolved to a significant degree. So I think the things that have conspired to make this a very subpar recovery are becoming less significant, and all the good that's happened in our economy will begin to shine through. Now, to get to my optimism, we do need to get through some pretty significant fiscal headwinds that are dead ahead. If you add up all the drag from all the various policy that's been implemented over the last couple of years, it's going to cut about 1.5 points from GDP growth in 2013, 1.5 percentage points. Just to give you context, the expiration of the payroll tax holiday, that's probably 0.5–0.6%. The sequester is about 0.5 percentage point, and all the other tax cuts and spending cuts, that's another 0.5%. So that's pretty significant. This is ambitious. I mean, the last time we've, as a nation, have gone through this kind of fiscal drag was in just immediately after World War II and the drawdown after the war. You know, the British have tried something a little bit more austerity than this. They had fiscal drag of 1.5–2 percentage points back a couple of years ago in the apex of their drag, and it's been pretty tough on their economy. So this is pretty serious stuff, and the apex of the fiscal drag in our country literally will be in Q2, Q3 of this year. So, you know, my sense it's going to feel a bit uncomfortable, that things are going to throttle back. We'll be lucky if we get 2%-ish annualized growth in the next couple of quarters. Job growth will slow, maybe not to the same degree, but it's going to feel uncomfortable. And we are going to be vulnerable at that point if anything else goes wrong. And I'll come back to that in a few minutes. But I do think we'll navigate through. You know, there's, if we do, you know, I think we're in pretty good shape. My sense is the debt limit will be increased, again, with a little bit of angst and brinkmanship and vitriol. But I think the politics are such that the Democrats and Republicans will come together and we'll get a reasonable solution to it. And I don't think we'll get much more additional deficit reduction of consequence, maybe some things on the margin, but I don't think it's going to be of a significant consequence. But that's okay. It's not great. It would be wonderful if we could come to terms on entitlement reform and tax reform and have more deficit reduction and get the debt to GDP ratio moving south in a consistent way. But I don't think that's going to happen. But again, that's okay. We have accomplished a lot in the last couple of years. You know, it's hard to believe, but all this sturm and drag, all this angst has resulted in some significant deficit reduction. And under reasonable economic assumptions, deficits in the future will be small enough that the nation's debt to GDP ratio will stabilize. At a high level, you know, admittedly, it's not a great place to be. Publicly traded debt to GDP will be about 75%, but you know, that's okay. And okay in the sense that fiscal policy is going to fade from the front pages and will allow the private sector to do its thing and for it to shine through, and we can really hit escape velocity and get moving here. How are you feeling? I haven't really given you anything meaty yet. Let me give you a couple of real substantive reasons for optimism. I'll give you two. I could give you more, but Mary only gave me 30 minutes, so I'll only give you two. And you should actually soak this in, because I will leave a few minutes at the end to take you back down. So just take this in. The first reason is I think we have righted a lot of the wrongs that got us into this mess. At core, the reason for the financial collapse in the Great Recession is that we made a lot of bad loans. Bad in the sense that under reasonable economic assumptions, these loans would not get repaid, and obviously they did not. Brought the system to its knees, required a bailout, and thus the Great Recession. But the good news is that we have worked through these problem loans in lightning speed. I think we have gone down roughly the same path every other economy historically has gone down in the wake of a financial crisis. It's not like we've done anything terribly different. It's just that we've done it very, very rapidly. We have, in fact, completed the deleveraging process. And you can see that right from the beginning of the crisis. Take the banking system. The whole stress test process was really quite amazing. I was very skeptical back in early 2009 about the efficacy of that policy step, but it actually worked out to be quite important. We required our banks to go through very stressful stress tests. They had to raise a boatload of capital, and it's now, I think, fair to say they have plenty of capital. If you look at the FDIC data, Tier 1 capital ratios, Q4 2012 were 9.25%. That's the highest it's ever been. On average, it's about 7.5 percentage points. Liquidity, very ample. Obviously, credit quality is very good and improving on a daily basis. The banking system is on very solid ground, and the credit spigot should steadily open. And this stands in striking contrast to what's going on in the rest of the world. Take the European experience. The Europeans still to this day have not engaged in a truly serious round of stress testing. The first round of stress tests, obviously wasn't very therapeutic. The Irish banking system went belly up a week after the stress test results were announced. The second round was a little bit better, but Dexia, the big Belgian French bank, went belly up a week or two after those stress tests. They seem to have gotten the hang of it, but at the end of the day, they haven't required their banking system to raise enough capital. And of course, the Europeans are much more dependent on the banking system to provide capital than here in the United States, where our capital markets are quite deep and very important. So their economic prospects are very, very different than ours, and it's largely because they have not delevered like we have. Non-financial U.S. corporations have done an excellent job of deleveraging. Take any measure of balance sheet strength that you want. It looks about as good as it's ever been in the data that I've seen. Interest coverage ratios, quick ratios, plenty of cash. Businesses have done a marvelous job reducing their cost structures. Profit margins are as wide as they've ever been. Profitability is very strong. They're very competitive. Unit labor costs today are about where they were 5-6 years ago. And in manufacturing, which obviously is globally traded and very competitive, unit labor costs are back to where they were 20 or 25 years ago. And that's all in dollar terms. If you put that into RMB terms or real terms or rupee terms, it's even more compelling. And then you throw in the fact that energy and availability and energy prices are going to remain low. I think our companies are sitting in very good shape. And the household sector also. Now here we have to make a little bit of a distinction between low-income households, lower middle-income households, and high-income households. Those folks in the bottom part of the distribution of income, they're clearly struggling. That's where we still have some foreclosure issues, and student loan debt is clearly an issue. But folks in the top part of the distribution, they're doing fabulously well. I'd say the top third, maybe even the top half. If they have any debt at all, it's a 30-year fixed-rate mortgage loan. They've been refining down, probably have a coupon now 4.5%, and they're trying to get down into 3.5% to 4%. They may have an auto loan, but the only reason they have an auto loan is it's free money. You get an auto loan for a couple, 3 percentage points. So why wouldn't you take an auto loan? And you can see it in the credit statistics. So we collect data from Equifax, the credit bureau, on all the credit files in the country. and compile this every month, and just got the March data. And here, just a statistic. If you look at the 30 to 90-day delinquency rate, percent of dollars outstanding on all household liabilities ex first mortgage. So let's just exclude first mortgage for a second. That's credit card, auto, consumer finance, student loans, home equity, closed-end seconds, you know, everything. The delinquency rate as of the end of March was 1.9%, 1.9%. Just for context, that's lower than at the low point in the middle of the housing bubble back in 2006. The low point back in early 2006 was 2.1%, 2.1%. Even first mortgage, we've made a lot of progress. The delinquency rate, 30, 90-day delinquent, percent of dollar outstanding, end of March, seasonally adjusted, stood at 2.8%. The peak was 7. That was in early 2009. And the low point back in early 2006, it was 2.2%. And 30-day delinquent is already at a record low. So the number of, the percent of first mortgage loans that are 1 month late is at a record low. 2 months late is almost at a record low. And 90 is still elevated, but coming down very rapidly. Yes, we have a lot of loans in the foreclosure process. But on the other side of that, once we work through those loans, the credit environment is unbelievably good. It's just beautiful. Pristine. It's going to be, you know, cutting across all bank assets. It's going to look as good as it has ever looked in terms of credit quality a year from now. How are you feeling now? Better? Okay. Let me give you one more reason for optimism, and this is where we get the juice. You know, this reason I just gave you, the deleveraging process, that it's over, is more what I consider a fundamental structural reason. Let me give you a cyclical reason. That's housing. You know, the housing market is kicking into full swing. Now let me give you a little bit of data just to reinforce the point. The current level of construction, that would be single family, multifamily, and manufactured housing, is running around 950,000 units. That's annualized. Just for context, at the low point back in early 2009, construction was running somewhere around 500 to 550,000 units. And that is as low as it had ever been since World War II. So that was a pretty low level of activity. So we've made some significant progress, and it is adding to economic activity. In a normal economy, not even, you know, a really good one, just a normalized economy, we should be producing 1.8 million housing units. That would be 1.25 million households that you get formed every year. That's just looking at population growth and the ethnic and age distribution of the population. And of course, we've been well below that for much of the last several years. 20-somethings can't find work. They've been doubling up with their parents. So you could argue there's a fair amount of pent-up household formation that will get unleashed at some point in the not-too-distant future when we start to get some more job growth. But let's just go with 1.25 million. 350,000 in obsolescence. So, you know, Hurricane Sandy blew through my neighborhood, wiped out 250,000 homes. Now, that's an extreme example, but we have hurricanes on the East Coast. They seem to be coming with increasing regularity and severity. Tornadoes and just normal obsolescence, about 350K. And then those high-income households, those folks, many of them are in their 50s. They're thinking about, that's the teeth of the boomer generation. They're thinking about second vacation homes, and we're building a couple 100,000 of those every year. So you add that up, 1.25 million formations, 350K in obsolescence, a couple 100,000 vacation homes is 1.8 million. We're going to go from the current level of construction, 950K, to 1.8 million over the next several of years. And that provides a lot of economic growth and a lot of jobs. Just another rule of thumb, every single family start generates somewhere around 4.5 to 5 jobs over a period of a year. So that's construction jobs, that's manufacturing jobs, you know, the lumber, coal or fixtures, all the fabricated metals, steel, cement. It's trucking jobs. You got to move all that stuff around. It's financial services jobs. It's a Home Depot. It's Lowe's. It's home improvement. It's cable hookup. It's landscaping. It runs deep into the labor market. And actually, this is very, very important to small businesses because smaller establishments, companies, those with less than 50 employees, particularly those with less than 20, are very tied in, disproportionately tied into the construction cycle. And you can feel it. If you look at some of the payroll processing data from ADP that we collect, you can see that the companies that are very, very small are now coming back to life, and job growth among those companies in the last 6 to 12 months has been stronger than at other size companies, which is a complete reversal of what had been going on throughout the economic recovery. Now, I could be a little optimistic about how quickly the supply side of the housing market kicks in here. You know, the recession was pretty debilitating to the housing industry, kind of wiped out the infrastructure for building. And it takes time to resurrect that, particularly in key housing markets like in California, where the permitting process is very cumbersome. So it may take a little bit longer than expected. I was at a Harvard Joint Center for Housing Studies meeting a couple, 3 weeks ago. And this is a really good meeting because you get CEOs of builders and building supply and finance companies that finance these guys, banks that finance these guys. And they were obviously very optimistic and euphoric, but the thing that they were most worried about is, can I get enough flatbed trucks? Can I get enough forklift operators? For the small builders, can I get construction land development loans? The big guys, no problem. They have access to capital markets and they have plenty of cash. But the smaller builders need the bank credit. And of course, banks are still, particularly smaller banks, are still quite reluctant to make those loans in the context of losses they've taken on that type of lending. So it could be that I'm overly optimistic about how quickly things ramp up. But if that's the case, then we're just going to get even more economic growth as we move into 2015 and 2016. It may not happen in 2014, but it will happen. I'm very convicted of that. One other thing I'll say about that is, if I'm wrong about the pace at which builders put up homes, I'm probably also wrong about the pace of house price growth. So currently, I'm expecting mid-single-digit house price growth, which is not much, slightly less than what we got in 2012. But if you listen to the builders, they're licking their chops. If they can't build a home, they're going to raise price, and they in fact would much rather raise the price than build a home. Much easier way to make money to raise price than build a home. And so we could see much stronger house price growth in the next couple of years than anyone's anticipating. The other thing that would support that is it appears that potential sellers are not putting homes on the market because they seem to have some kind of reservation price in mind. They have in their mind what is a fair value for their home. Some obviously are underwater and they're not going to sell until they're above water and can cover their transaction costs in a sale. But others feel like, I know what my home should be worth and I'm not going to list that home until I hit that price or come close to it. And if that's the case, we could see some if you look at inventory of homes for sale, they're rock bottom, they're very low, and so that could mean we could get some really heady house price growth over the next couple of years. And of course, that has negatives, but I think at this point, much bigger positives, and will be very, very good for economic activity. So the reason I think that I am more optimistic than the consensus is not because everyone else doesn't know this about the housing market, but I think they are underestimating how powerful this is going to be. Just like many underestimated the drag from the housing collapse on the flip side back in the teeth of the economic recession. This is it. This is the apex. How are you feeling? Okay. Let me end with because it is appropriate to talk about the risks, because there are plenty. And let me just stipulate that Washington remains a risk. The debt limit is a thorny problem, and again, we're going to be debating that when the economy probably is going to be on the soft side. Remember, the next 6-9 months are going to be, I think, a bit uncomfortable, and Washington could make that worse. So we'll just stipulate that as a risk. Let's stipulate that Europe is a risk, much less so, but nonetheless, these countries are under severe economic pressure. Unemployment in the entire Eurozone is now 12% and rising. The full unemployment rate in Europe and the Eurozone is probably somewhere around 8.5%. You go into Spain or Italy or Greece, this is real stress, and the political process could come unraveled. I don't think that's the baseline, but it's certainly a possibility. So we can't discount that. And there's always given what happened with the Cypriot banking situation, that reminds us that there is the possibility of a policy error that could make things go in the wrong direction. There are other geopolitical risks. I mentioned two. There is obviously North Korea. We all discount that, but again, you can't really handicap it. The other thing, the other geopolitical risk, though, that I worry more about is Iran and the Iranian oil embargo. Despite all the good things that are happening in our energy sector, we still are very energy dependent. Oil prices rise. That's a big, and gasoline prices, and you guys know this better than I here in California. That's a big problem. So I worry about that. But let me end with one last risk. This is the risk I hear nonstop now when I travel the country, and that's the risk posed by rising interest rates. So if you buy into my scenario, my narrative, obviously it implies higher interest rates. I've got Federal Reserve quantitative easing winding down towards the end of the year, coming to an end in early 2014. I'm a little bit more optimistic than the sort of the midpoint of the Fed forecast. So I have the Fed raising interest rates beginning in early 2015. I have normalization of rates in the so-called equilibrium. Say federal funds rate target's about 4%. I get there by the end of 2016, early 2017. That's my outlook. Of course, long-term interest rates rise faster than that. The bond market anticipates. So I'm just rounding here, but the 10-year bond is south of 2, ends the year at 2.5, ends next year at 3.5. Normalizes the sort of equilibrium 10-year yield is about 5%. We get there, sometime late 2015, early 2016. In all likelihood, we overshoot. If that's kind of the scenario, we're good. We're okay. I mean, the rates are rising because the economy is doing better. We're generating more jobs. Unemployment's falling. Everything's it does ding the housing market a little bit, but it won't undermine it because the job market will be being fueled by the better. The housing market will be fueled by the better job market. But the risk is that, and the theory is sound, and the empirical evidence that we have would suggest that this is the way it should work. And if you look at what happened after the end of QE1, QE2. It's a lot of moving parts there. It's hard to disentangle all the things that are going on, but it's suggestive of the idea that this is the way interest rates should rise in a slow, orderly way. But the risk is, and the concern is out there in the world, is that we got this theory is all wrong, and that interest rates are going to rise a lot faster than people anticipate as bond investors are going to, everyone knows in the bond community that the terminal interest rate, the 10-year bond is 5%, so they may take it from 2 to 5 in a lot, not over a 3-year period, but over a 3-month period. And of course, that were to happen, that would be a significant problem for the economy. That's not my baseline. I don't think that's the likely scenario, but that is the concern among folks out there. One last point about that: even in my baseline, there will be financial stresses as a result of that kind of rise in interest rates. There always is. There will be some kind of financial event. It probably won't be in the regulated banking system just because the stress test process is now accounting for this. The adverse scenario in the stress test is exactly this interest rate scenario, so the banking system should be well prepared for it. But the shadow system is in all likelihood not. So even in my outlook of slowly rising interest rates, I think we're in store for some bumps along the way. I will end there, and you will be happy to know that I hit my 30 minutes to the second. Thank you very much.